Hi, Terry and Gerry. Thank you for joining our program today. Well, I know the HKIFA has worked with the Securities and Futures Commission to work on a recommendation on risk disclosure enhancement for the more than 2,000 authorized funds in Hong Kong. Can you tell us why you need to do such a recommendation?
Sure. Perhaps if I start off first. We've been working very closely with the Securities and Futures Commission on the practices relating to disclosure in the mutual funds and unit trusts, particularly those that are authorized by them. Since the fourth quarter of last year, there have been a lot of discussions with them on what is appropriate in the current environment, given the volatile market landscape and some of the changes that have taken place. And so we've established some working group with various individuals within the SFC and come together and recommended how certain disclosures may be better revealed within the fund documentation. And this follows on from a release made by the SFC at the end of last year, where they basically specified certain requirements that we all agreed would be better for investor protection purposes. So as a result of that, there have been a series of meetings between our two parties, getting feedback from the industry, issues that may be raised. What does it apply to? Does it apply to only advertising or certain documentation, and all the practical questions, and then we pull it all together for the ease and purpose of reference of all members of the fund management industry.
And as you mentioned, that this guideline has been issued in December last year. So why bother this 4 months of discussion to give a more detailed practical note?
I think it's important that because the guidelines that were issued were of a general nature, spelling out the principles, the ongoing discussions and meetings, consultations were to do with the practical aspects of it. So the type of wording that we would use, where it would be placed on a particular piece of documentation, the situations in which the new disclosures would apply, whether it would apply to, say for example, advertising on a bus versus a sales guide that you get in a distribution outlet, say at a bank. These are sort of the practical issues that could not easily be achieved within a simple letter which outlined the principles. So I think it was important, for the sake of the different members, to be able to have a better idea what does it actually mean in practice.
Is this new regulation mainly because of the mini bond fiasco that actually many investors found that they actually did not understand the risk involved into that product?
I think we really need to look at this in conjunction of all the history behind, for example, the advertising guideline that was discussed, the discussion started in 2008, and where the regime went from pre-vetting in terms of marketing material to a post-surveillance environment. And what this really is just a enhancement on top of that. Now, I think it is important that anytime market changes, and I think the SFC is reacting to in such a way that investor needs to be better protected, which from an industry perspective, we're all supportive of that. This is why, I think from a timing perspective, it seems this is obviously the case, but I think that, if we look at the background, there are a lot of discussion which is prior to the third quarter of last year. In fact, the revised advertising guideline discussion started a lot earlier in 2008. So I think taking a more holistic view, these are changes that the industry is making to ensure that investors are in the know, if you would, and whether it's one particular issue leading to this, we don't believe so. But again, from a holistic angle, as long as the investor benefits from the changes and is implementable, this is something that I think the industry and the SFC strives for.
I think, simply put, I suppose regulations quite often is an evolution, not a revolution. So we're basically evolving from what Terry mentioned earlier, the pre-vetting to a post-vetting regime. And I suppose it has to reflect some of the issues that we face, the changing environment. So the incident you mentioned is one, but basically there's a lot more requirement for investor protection in the current volatile environment. And I think these changes would basically draw a balance between what is best for investor versus what's right for regulation and what sort of products we want to bring into the marketplace. So it's basically striking a balance between all these different requirements.
Well, thank you for joining our program today.
Thank you very much.
Thank you very much.